On today's hot sheet, I'm discussing CoreLogic's HPI report for February, mortgage applications, job openings, and labor turnover, as well as the ADP employment report. Today is Wednesday, April the 3rd, 2024. I'm Byron Lazine, and the hot sheet starts now. Welcome into today's hot sheet. Love to know in the live chat which market you're tuning in from. By the way, at the beginning of June, there's only one market you should be in on June 6th specifically. That's Washington, D.C. We're getting in and out of D.C. well before November, so you don't have to worry about any of that baloney. But you should be worried about BAM Camp and not missing it. If you missed Naples, Florida BAM Camp, you do not want to miss this one. BAM Camp DC is on June the 6th. We have a mastermind on June the 5th, and there's a link down below because early bird pricing ends this week. Do not miss out on early bird pricing. By the way, if you're a BAMX member, use your discount code to get an additional 25% off even the bottom price of BAM Camp. BAM Camp on June 6th is something you do not want to miss. I can't wait to spend some time with you there. Now let's spend some time together on today's topics. First being the CoreLogic data, which has now just been released. So their forecast or their house prices for February 2024. We also have their forecast through February 2025. Let's get into both. One thing we can note right off the top is that home prices continue to be strong. Who are the biggest winners in this real estate market? A real estate market that saw a recession just over a year ago. A real estate market that continues to have themes like unaffordability and high 30-year fixed rates. Well, who continues to be a winner? That's certainly people who already own homes, the home owners. They typically win. We go back the last 4 decades, and we can see how much they've won in terms of appreciation, as well as stabilizing their expenses. Well, home prices over the year since February 23 to 24 have now increased 5.5% year over year. That's again, according to CoreLogic. That increase also reflects a 0.7 month over month increase for February 2024. Home prices nationwide. This includes distressed sales. Saw that year over year jump of 5.5%. So everybody that's been waiting on the sidelines or taking advice other than their local real estate professional have missed out over the last 12, 18, 24 months on these gains. They continue to see the homes that are on the market go up in value, continues to prolong their ability to become a homeowner. Those month over month prices almost jumped a full percent. That's a lot, right? If you're going to be waiting now into the spring, do you anticipate that month over month continues to grow, or do you see it declining? I know there's some markets out there where you could argue that inventory is going up enough that there might be a cooling off or a decline, but these are nationwide numbers. And in almost every market across America, this is what we're seeing. This is the average across the landscape. You should know your market better than anybody else and be able to articulate the difference between the macro and the micro. But remember, most of your clients are reading headlines and macro, so know both. The CoreLogic HPI forecast now, so forecasting out, predicts a 0.4% rise in home prices from February 24 to March 2024. Okay, so this month, a little bit less than last month is the forecast, 0.4%. Now, the year over year is expected to drop from 5.5 down to 3.1% increase year over year basis from February 24 to February 25. Remember, last spring is when we saw some of these prices have their biggest jumps. Annual home price growth in the U.S. remained consistent with numbers seen last fall in February 24, but finally slowed as the residual impact of comparing gains with the week 2022 prices wore off. All right. Now let's take a look at some of the regional locations quickly. Here's the forecast that I just went over here for you. This is what we currently have. This is the current month over month, current year over year. For when we get into next month's report, we'll see how accurate they are on that. Now this could be this will be available for everybody in BAM Max. You'll be able to grab this. But this could be one of those things that shows, hey, don't, like, for people that are saying I'm going to shy away from the spring, hey, prices are continuing to go up. But when you compare March over March, March might, only up 3.1% from March over March. So March, when there's an abundance of inventory in whatever market you're in, because we see more homes coming up, or I'm sorry, April, April or May rather, when there's more of this inventory, and we're only talking 3% year over year, are you going to continue to wait 9-10 months because we've got a 3% increase? This could be an argument to help somebody get off the fence and make a decision. Okay. Nationally, the increase was 5.5%, but now let's start getting into regionally. The states with the highest increases year over year were South Dakota at 13.8%. This is year over year, February to February. New Jersey at 12.5%, and Rhode Island at 11.6%. You can see the states in red. This is not a political chart, although it's red and blue. The red means bigger gains. 7+% is that dark red. That's where, rarely would you ever see the Northeast highlighted in so much deep red, but that's the case here. The Northeast is up 7+% in every state. Look at that. Connecticut, Rhode Island, Massachusetts, for New Hampshire, and Maine. Maine, shout out to Maine, getting a huge snowstorm, I believe, today or this week. Big snowstorm coming into Maine. Okay, so New York, the only Northeast state with more of a subtle increase, but of the 1 to 3% there. So really the whole Eastern Seaboard, look at Southeast continuing to have prices. California experiencing big year-over-year price gains. You see Texas, Louisiana, some of those northwestern states were the states where you saw either little increase or even a decrease. Okay, so that's the national landscape there. Taking a look at in select metros here, where some of the big gains were. Miami continuing to just be a rocket ship of home price appreciation at 10.2%. Boston at 5.8%. DC at 6.1%. Chicago had a great 12 months at 8.4%. Houston now 2.7%, where we saw other markets like Austin and San Antonio struggle a bit. Denver, Phoenix, Las Vegas, LA, all up, and San Diego up almost a full 10%, just highlighting a few of those metros from this CoreLogic report. Now, CoreLogic comes out with this every single month. These are the top markets at risk of a home price decline. I would put in here, so they've got Sarasota in here. I would certainly put in a place like Punta Gorda, also on the west coast of Florida, south of Sarasota, where we've seen now over about 30% inventory for pre-pandemic levels. If we're seeing inventory above 2019 levels, that to me is one where the risk of declines is going to be high, because when you get inventory to ratchet quickly above 2019 levels, no matter what market you're in, the serious sellers are going to see the competitive landscape having changed over the last 24 months. And the smart sellers working with great listing agents are going to position themselves to be the first home to sell. If you have a community where like a lot of the homes are the similar, then most buyers, certainly smart buyers, are going to look at all of them available. Hey, let's do a tour. Let's knock these out in 15 minutes. Let's get through all 6 that are on the market. And the one that's competitively priced, obviously with the best upgrades and all of that, is likely going to be the one that moves first. Okay, on this list, though, is Palm Bay at a very high probability of a price decline. Atlanta, number 2. Daytona Beach area. Spokane, Washington, they're at 4. And again, Sarasota Metro is in at 5. So Florida making 3 of the top 5 top markets at risk of home price decline. And then you have Atlanta and Spokane Valley, Washington in the mix as well. Okay, moving along here, more of this data. Anything else here for me to note? Here's the states, by the way. This is in your BAM X show notes, so you can grab it. I mentioned some of those top states: South Dakota, Jersey, Rhode Island, but you also have Maine, Connecticut, New Hampshire, Wisconsin, Illinois, Ohio, and Michigan. If I'm an agent in any of those states, because remember, this is year over year. This is the recent report within the last 24 hours from CoreLogic. I'm doing a headline on email. Our state made the top 10 in price changes, ... Write that down if you're in one of those states and you're sending an email, or if you're in one of these metros. This is why these show notes on BAMX are so important. Like, our city made the top 10 in home price changes, ... Why am I not saying top 10 for good or bad? I want somebody to open the email. Okay. So what's the change? What did we make? What's the list? Boom. Then I get into the body of the email and I explain that change. Okay. You can do this in your own MLS with your own data as well. All right. Let's get into some data that we're tracking very closely. We do this every single month. It's really important going into the spring market to understand how much demand there really is. We know off of feel, off of conversation, off of our databases that there's a lot of pent up demand. There's a lot of folks who would sell if the rates were conducive to them buying on the other side and giving up the 3% rate. We get all that. But what do the numbers from Mortgage Banker Association actually say? Do we have a lot of demand coming into this spring? Mortgage applications decreased here in the last week by 0.6%. That's from data from MBA survey ending for the week March 29th. The composite index, a gauge of mortgage loan application volume, was what decreased to 0.6%. When you unadjust, the index shows 0.1%. Unadjusted means adjusted for seasonal or not seasonal. So the unadjusted basis declined less at 0.1%. The refinance, which I don't really care about, declined 2%. It was 5% lower the same week a year ago. Now the purchase index only decreased 0.1%. So when you pull those refis out of that total number of 0.6 that I just went over includes refis. When you pull it out, the seasonally adjusted purchase index only decreased 0.1% from a week earlier. Okay, so we're kind of flat here. Now it is 13% lower than the same week 1 year ago. We're seeing less sales. We're seeing less demand. Okay, that's the reality of the market that we're in. It does, the projections moving forward on how many sales tells me that things are going to continue to get brighter and brighter as we move forward. I feel like this bottoming is now or behind us. So I know, listen, feels like things just kind of drag on forever. By the way, I'll mention inflation here before inflation might be back. If you're looking at the 10-year, which we're going to look at again, if you're looking at how the markets are reacting the last couple of days to start quarter two, there are some concerns that inflation is back. I didn't say runaway inflation. Okay, don't put words into these sentences that don't exist. I didn't say runaway inflation, but there's a lot of thoughts on Wall Street that inflation is back. It's rearing its head, and this is what I talked about from January 1 about the bumpy road ahead. We're now a full quarter into the year. And I've been saying for 90 days, don't talk 5% rates. You're not on the 30-year fix. You're not going to be able to see that this year. Even if we get to 5.99, Walmart version of 6%, 5 is what a consumer thinks is 5.0. Let's not mislead consumers. Okay. Consumers are going to drive demand. We know that if we can get that 30-year fix down, this demand that we just looked at will undoubtedly go up. We're all rooting for it. I just also want to set expectations where they should be. Job openings are something that Jerome Powell, along with inflation, is taking into consideration when he's deciding, and the FOMC is they're going to make price cuts. It also speaks to how strong our economy is, and if there's a potential recession looming. The number of job openings on this last week's report remained unchanged relatively at 8.8 million. This is off of the peak of 11 million. So there has been some stabilization on how many job openings there are. This is according to the last day of February. with Bureau of Labor Statistics. It's down from a series high of 12.2. I said 11. 12.2 was actually the high on March 2022. So we're in a better spot there for job openings. Really, this needs to come down even further. But people that really dig into this say, well, okay, there's all these job openings, but there's not a qualified unemployed group to fit. That might sound a little weird, but some of these job openings, it's not that there's not demand for job. There's not a lot of people that can fill these jobs, and I'm not an expert on that, but that's how I understand it. Job openings increased in finance and insurance, state and local government. Job openings just continue to open up there. We saw President Joseph Biden Jr.'s proposed budget of almost $8 trillion. And so all, year we've been looking, wow, state and local government's a leader in hiring. Certainly the next budget would reflect more of that. Job openings in the arts, entertainment, recreation, but decreased in information and federal government. So state and local job openings increased, but federal government decreased. Okay, so there you go on that. Hires were a little change at 5.8 million. Slight decrease observed from durable goods manufacturing. And so there you go on job openings. We also have an ADP employment report, payroll. Private sector employment saw an increase of 184,000 jobs in March, indicating positive momentum in the labor market. Year-over-year annual pay rose by 5.1%, demonstrating significant growth in earnings for workers, but also that's off of that previous high. So that is starting to stabilize a little bit. March was surprising, not just for the pay gains, but the sectors that recorded them. This is a quote from Neela Richardson, a chief economist at ADP. The three biggest increases for job changers were in construction, financial services, and manufacturing. Remember a previous hot sheet I talked about Home Depot buying that big distributor, $18 billion, and trying to get the construction workers, the LLCs, those local contractors to come to them, or making a bet, not trying to, but making a bet that they would see an increase in construction. That isn't going to end, folks. Like there's a huge opportunity in the construction and home rehabilitation world here moving forward. Financial services and manufacturing were the other gainers. Inflation has been cooling, the report says, but our data shows pay is heating up in both goods and services. And that's something, if pay is heating up, that could re-spark inflation. I mentioned to you that there are signals right now that inflation might be picking back up. The number that I just gave you about 48 hours ago, that Wall Street has a 61% chance the Fed's going to cut in June's, was it June? Yeah, it was June's meeting. They were going to cut the federal target interest rate, 61% chance. That has been going down the last couple days. I mean, look at this now. The 10-year Treasury is up at 4.425. You could put money in, you could put as much money on it as you want, that if this holds here throughout the day, the 30-year fixed rate is going back up again here today after 2 days in a row of breaking 7 once again. 7.05 Monday, 7.06 on Tuesday. Today's read will be higher than the 7.06 just based on where the 10-year is. The 10-year and the market so far here to start to start quarter two is uncertain. Okay, to put it kindly, is uncertain. If we just look here, we're looking at a third day in a row here where Dow futures. Let me go ahead and refresh this because we're past 9:30. Okay, so Dow's up a bit here. S&P, NASDAQ are down, but we have uncertainty in the market. This is no question about it. I mean, here's an article right here, and this is what I'm talking about with Wall Street. You're starting to see this in the last 48 hours quite a bit. You're seeing really prominent figures on Wall Street say the Fed may have a hard time on this last mile of inflation. Okay, inflation was falling in late 2023, but there were several upside surprises in data during the first quarter this year. Okay, it's why I cautioned against, believing this first quarter was just going to drive rates down. Hasn't happened. Those bumps in the road surfaced. The Fed thinks it will eventually come down to 2% inflation. Jerome Powell's been adamant about that. We cover that every time he gives a speech. But Cohen on CNBC recently said, I think it's going to be hard. Okay, that this last mile of inflation is, or this last 2 or 3 innings is going to be difficult to get it down to the 2% target. He also said the current market rally, it's not a bubble like the 99.com boom, but instead due to part to investors pricing in future growth from AI. It's also due to investors saying, hey, I expect this cut to come in June. 61% of them on Monday said that. Now less than that number expect that cut to come in June. We're rooting for it to come in the first half of the year. By the way, we're going to have DC in our camp, presidential election year. DC is going to pressure Jerome Powell to make these cuts sooner than later. They want those cuts to start impacting the market pre-November. There's no question about that. So we're going to have significant pressure on Jerome Powell to do this, but he's been pretty steadfast that he won't do it until he sees we're heading in the right direction. The sticky inflation here in quarter one would be an argument certainly against that. The only thing I would argue, if you want to be the best version of yourself as a real estate professional, mortgage professional, whatever the case may be, is that you got to get yourself signed up for BAM Camp on June 6th in, speaking of DC, in the Washington, D.C. area. There's limited space available, and we're going to end, because tickets have already been selling, we're going to end early bird pricing here this week. Make sure you sign up for that. BAMX members, you get an additional 25% off of that bottom price. So make sure that you use that, or email jill@nowbam.com, JILL@nowbam.com, if you have any problems figuring out as a BAMX member your discount and how you get your discount on to BAM Camp. All right. By the way, BAMX members, we've got a office hours today. So if you are a BAMX member already, or if you sign up here before today, I've got an office hours with CEO of Mosaic, Sheila, on how to operate your business at a higher level. We've had a whole bunch of questions for BAMX members about Mosaic, so we're going to get into that as well. Hope you guys have a great Wednesday. That's at 3 p.m. So reminder for BAMX members, 3 p.m. Hope you guys have a great day. We'll be back here, of course, tomorrow, 9:30 on the East, 6:30 in the West. You know the deal in between. And until then, toodaloo.